I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
As I said when I introduced this session, I've been at this since 1981, so I've learned how to improvise. We're waiting for Bob Mundell. We're confident that he will emerge at some point in time. But so that we could continue what has really been an interesting train of discussion, we thought until Bob gets here that we could extend the conversation with Brian Dimitrovic. And if you haven't read his book, Iconoclasts, you really should, because it was my own inspiration for putting something like this together. He really lays out the historical evolution of this process in brilliant detail. So I think what we'll do is have Paul Gigot talk to Brian a little bit about the importance of Mundell in setting this whole process off, and some of the other players. And then when Bob gets here, he can join the conversation. So with that, I'll turn it over to the editorial page editor of the Wall Street Journal, Paul Gigot.
Thank you, Larry. So thank you, ladies and gentlemen, and thanks for, especially here for Brian, for filling in. And why don't you talk a little bit, because you have studied this period so intensely, why don't you talk a little bit in the context of Bob Mundell, but talk about the intellectual roots of what became known as supply-side economics. That supply-side, of course, was the phrase, and he didn't mean it as a compliment, that Herb Stein applied to it. And some of us said, that's pretty good, took it and ran with it. But it does have serious intellectual roots. Yeah. Talk about that.
I bet it does. I mean, I'm going to take you back to the 1950s when Robert Mundell was a student in industrial economics at MIT. He said it was his study of international trade that made him realize that if you raise taxes, that capital will flow out of the country. So you can conduct monetary policy actually by cutting taxes. And he's going to tell us all about it.
There he is. All right, thank you very much. So, Robert Mundell. He is, as you all know, one of the world's greatest living economists, known for his support, or so his having been present at the creation of SupplySide Economics. But in the economic profession, he's most well known for his work on currency areas and international exchange rates. And his scholarship laid the groundwork for the euro and resulted in 1999 with his being awarded the Nobel Prize in Economics. He's received many awards, including the Order of Canada from his home country and the Jacques Rueff Prize by the French Senate, which is actually one of the best things the French do. Since 1974, he's been a professor at Columbia, but he travels widely to advise governments, including the Chinese, where he is highly regarded. And some of you may also remember him from his appearance on the Late Show with David Letterman over the years, where he has delivered several top 10 lists, including Ways My Life Has Changed Since Winning the Nobel Prize, and telling Yo Mama and You Might Be a Redneck jokes. The ratings for that probably were pretty good, Bob, don't you? Well, let me start here by saying, my old boss, Bob Bartley, used to quote you as saying, for every policy objective, you need a policy lever. And in the 1970s, the objectives were, or the problem was stagflation. So the objectives were break the back of inflation and promote economic growth. You prescribed tax cuts for growth, monetary restraint to break the back of inflation, and it worked wonders. What are the main policy objectives now, and what levers would you pull?
Well, first of all, let me say I'm delighted to be here at this centenary of Ronald Reagan, one of the very great presidents, and to be part of this celebration for him.
Do we have the mic? You want to just give him yours? We're just going to use the second one.
Well, then let me repeat what I said. That I'm very happy to be here at this centenary of Ronald Reagan, who I regard as one of a very few very great presidents of the United States. And one of the, I guess, single one or two, maybe two or three people, that understood the importance of taxation and the effect of taxation on stimulus for the economy and incentives. So you asked me the question. You said that in the 1970s the problem was inflation on one hand and unemployment on the other, and you needed two ideas for that. One, monetary restraint for the inflation, and you needed tax cuts for the growth. Now, I had come to that kind of policy mix in a different framework in the 1960s, about a decade or so earlier, when I came to the IMF first in 1961. And at that time, John Kennedy was pushing the importance of getting growth going. And the issue was what policy mix would be appropriate for it. And in the 1960s, in 1961, the consensus, conventional wisdom, if you like, of people like Paul Samuelson and James Tobin was that you needed low interest rates to stimulate growth, and then you had a budget surplus to offset the effect of this on inflation. And now, in my first paper that I wrote at the IMF, I said that this policy leads away further and further from equilibrium. And what you have to do is to reverse the policy mix and have tight money to balance the payments and tax cuts to stimulate the economy. Now, the important point and difference between that period and the period in the 1970s was that in the first period, the exchange rates were all fixed. All the currencies were fixed to the dollar, and the dollar was fixing the price of gold. So it was like a gold-dollar standard system. And I think, as you know from history, that at the Economic Club speech in New York that John Kennedy gave, he reversed the policy mix after 2 years and then shifted away from that. The first 2 years were disastrous from that standpoint. And he shifted around, and then it got into he was killed before he could see the fruits of it, but the Kennedy-Johnson tax cut of 1964 was a very important part of this thing, and it led to great growth in the rest of the 1960s. And there was still monetary policy free then for maintaining whatever equilibrium in the balance of payments could be achieved. Of course, you couldn't have real equilibrium because the system was already hopelessly out of kilter because the world price level, the price of gold had been fixed in 1934 at $35 an ounce, and the world price level had gone up 2.5 or 3 times by that time, so gold became so undervalued that there was no way you could restore equilibrium in any normal system except by a big increase in the price of gold, which it was not politically possible at that time. It certainly wasn't advocated at that time. So the innovation in the 1970s was we don't have the exchange rate to predict, but the alternative for it is inflation. Because of course, when you have a fixed exchange rate system, all countries are part of that. They all have to have more or less the same inflation rate. So fixing the exchange rate was the way of achieving monetary discipline. But under floating rates, you have to use the monetary system for targeting, and you need then tax cuts to stimulate the economy. Now, the difference, I have to make a very important difference between this and Keynesian policies was, and this is a combination that Art Laffer and myself worked up and felt very strongly about, it had to be tax cuts. It didn't mean in the Keynesian system, government spending is just as good as having tax cuts. But in our system, it had to be tax cuts because you had to produce jobs for the private sector of the economy. That was only, in the long run, the hope for the economy. And it was particularly important in view of the tax cuts that existed at that time, tax rates that existed at that time. The tax rates went up at the 70% at the federal level alone, and up to 80 or 85% if you count state and local tax. So the marginal effects of tax rates were very, very punitive, and this was hampering economic growth. In fact, it had done the big problem all the way since the Great Depression, when tax rates in the 1920s had been maximum 25%. After Andrew Mellon, Secretary of the Treasury, got tax rates down after the World War I. But then in 1932, on June 6, Congress passed this bill shifting the top tax rates up to 60%. And President Hoover signed it, unfortunately, and it went into law. And ever since, tax rates went up to 92.5% during the wartime, excess profits tax.
But
and
Bob,
then we gradually got down to the 70% at that time.
But Bob, we were discussing earlier that that victory, the tax victory, policy victory from the 70s and 80s was so complete that Art Laffer was saying now that taxes really are not the biggest issue. And therefore, tax cutting does not need to be as central to a reform agenda now as it had to be then. Do you agree with that?
Well, the higher the marginal tax rate is above its equilibrium, its optimum, the more urgent it is to cut it. So when tax rates were 70%, it was very important to cut it. They were 80%, then the Kennedy bill got it down to 70%. So it was very important to cut it then. But it was more, still quite, you look in the 1970s, remember in 1980, the inflation rate was 13.5%. We had 3 years of two-digit inflation, 1979 to 81, 11%, 13.5%, and 11%. And so every year, people were being pushed up into higher and higher income tax brackets, and it was very painful. Now, things are in better shape than they were. However, there's a bill. The Bush tax cuts were not made permanent. They were 10 years, and they were extended for 2 years. But there's this sort of Damocles hanging over of a big reversion back to the Clinton-Gore tax cuts. And this is a tremendous deterrent for plans for investment. So it's extremely important to, number one, at the minimum, make those tax cuts permanent, but to go forward with further aspects of the tax revolution. If not simply lowering the Bush tax cuts, maybe that's a political equilibrium of these, but on the corporate side, because now the whole world is different from what it was in the 1970s. The United States has the competition of all these very strong and powerful Asian economies that are competitive and going to take over the dominant industrial markets in the world if we don't make, I think that 35% corporate tax rates, which makes the United States a 35% owner, in fact, in what the corporation produces, it should be cut down to 20% or 15%.
So the next stage of the tax revolution, in your view, would be for the United States to cut the corporate rate down to 20, which would be
but make the Bush tax cuts permanent. That's a very big if, because putting it ahead to 2012 is it's an election year, a presidential election year. It's going to be the biggest issue on the fiscal side in the election year. But I think even now, right now, very important I think it would be important for this president to have the these tax rates cut, because I think that is the secret to getting the U.S. economy going again. You start investment, it would be a new field again. It would be a little bit like the freshness that occurred in American industry after the Reagan tax rates of 1981 and 86, and with creating the Silicon Valley IT revolution, and it would start the whole process going. And with those tax cuts on the corporate side, you might or might not lose revenue from it. Probably you might lose corporate revenue from it, but not necessarily if instead of a stultering, sluggish economy for the next 2 or 3 years, you had a rapidly growing economy, then you'd make up for it on the income tax side.
So, and you wouldn't mind having a split between the corporate tax at top rate at 20% and the individual rate at 35%? If you wouldn't mind having a corporate rate that was at 20 and a top marginal individual tax rate at 35%?
My preference would be 15%.
15 for both.
15% on the corporate side, and then that's the keep the Bush tax cuts permanent.
Okay. What else on the fiscal policy side, Bob, is comparable to the decisions on to the tax cut agenda from the 70s? What do you see? How urgent a problem is spending control and regulation?
Well, I mean, the economy has two fundamental problems now. We have first the problem of excess unemployment, at least 4 percentage points of excess unemployment. Instead of 9%, we should have 5% maximum unemployment. So this is a major problem, both a political problem and an economic problem. And then on top of that, we need to get new growth going. We need to increase productivity and growth in the economy and make the economy lean and mean a little bit the way it started to become in the 1980s.
Is there a part of the Reagan policy mix that you think was left incomplete? Because Lou Lehrman made the point earlier, and Bob Bartley used to say that he thought one of the incomplete parts of the revolution was monetary policy reform. Do you think?
Well, let me just say, though, still on the fiscal side, I think if there was a weakness in the Reagan program, tax program, it was in the capital gains tax, which the capital gains tax was quite put at the same level as the income tax, which is a very bad thing because it's the cost of risk. It doesn't allow enough for the risk of future investments.
The capital gains tax went from 20% to 28% in the 1986 reform. A lot of economists think that really hurt the economy. It's now back down to 20, I think, isn't it? Or it's 15, that's right. It fell to 15 again.
15% for the corporate tax and 15% for the capital gains tax.
And would you, so you don't...
In economic theory, there's no one in public finance who's ever made an argument for any kind of tax on corporations. It's a tax on an institution, a corporate structure. It's like having a special tax on partnerships or a special tax on solitary individuals. There's no justification for that as a tax because individuals are taxed again anyway. It's a double taxation, and it's always been inefficient. What happened when it became important, it was about 13% during the Great Depression. Then it got up to 50% and then got down to what it is now. But it became a cash cow. And it was a cash cow, a very good cash cow at first, because it takes a long time for people in the industry to wear out and the effects of it. But gradually it was less and less, more harmful and less valuable from the standpoint of producing revenue.
Would you take the capital gains tax to zero? Would you take the capital gains tax to zero if you could?
In Europe?
No. Would you reduce the capital gains tax?
There's an echo. I'm getting
just so the audience knows, there's a bit of a reverb here, which is why we're having a hard time hearing. It's now 15%. Would you take it all the way down to 0%, the capital gains tax, if you could?
Well, there's as I say, people haven't made in the theory any argument for this, but I think that there is some element where corporations have some special entity that could may have a lot of costs associated with them also. And maybe the government has to pay and contribute to some of these costs. If they fail, they may have to be bailed out. There may be an argument for keeping some kind of tax. So I wouldn't say abolish all taxes. When all taxes get up, the higher and higher you make other taxes, the more it's efficient to start to raise other taxes in order to spread the burden.
Okay, we had a pretty vigorous debate this morning about monetary policy. And there are a lot of people who think that monetary reform is now crucial to getting back to a real growth economy. How crucial do you think it is at this moment?
Well, I think there's a fundamental reason for changing the way monetary policy works. And for a certain reason, the big problem is the kind of monetary policy you follow with a world of fixed exchange rates and the kind you follow when there's flexible exchange rates. And the fact is the system works really completely differently. But the Fed doesn't really take account of this and doesn't understand it. Now, if you look back, some of you may have read Milton Friedman's opus on work. He says in his work going from 1870 up to the 1960s, there's a long and variable lag in the effect of monetary policy. And the lag is goes from something like 8 to 18 months. Now, anyone who pays attention to the world today knows that's poppycock. And of course, but this, Friedman's data and Schwartz's data was all based mainly on a period after 1880, over this 50 period to 1930s, of fixed exchange rates. And to an extent that's correct. It's more correct under fixed exchange rates, but it's absolutely incorrect under flexible rates. Two proofs of this. First proof is in the late 1970s and 1980s. In the late 1970s, you had the dollar sinking, you had inflation going up, you had oil prices going up, and the price of gold shooting up to the sky to $850 an ounce over that period. You have the Fed over that period was not paying attention to the role of the exchange rate in importing that inflation. I talked to Henry Wallach and other people about this, and Paul Volcker also. I said, I can't understand why you don't pay attention to the exchange rate as an indicator of future inflation. And that they've got a 13% inflation, the highest in peacetime ever, in 1980. It was a disaster. They were not paying attention to it. Well, then what happened, Paul Volcker, who had been appointed in 1979, and was a little bit for the last year, a little bit to blame for that continuing inflation. But 1980-81, Reagan was elected and promised to stop the inflation, and that with the tax cuts coming and the increase in spending, fiscal expansion, Reagan tightened. And what you got was, of course, he tightened too much and you got a recession. And then you got out of the recession and we got great growth. But what he got from the inflation was 13% inflation in 1980, 4% in 1984. That's not a long and variable lag. That's a very quick lag. And the effect on monetary policy when he was tightening, it brought interest rates up to 22.5%. And the long-term 30-year bond rate in the United States went up, some of you may remember that, went up to over 14%. The long-term 30-year bond rate, 14%. Imagine, never before could you have that. Well, but the quickness of the effect was immediate. And you have an even better example in the 2008 period, debacle, as I think of it. You have this period of low dollar and inflation, exported inflation. The other countries had a lot of inflationary pressure and were wondering should they appreciate their currency. Alan Greenspan proposed in Saudi Arabia in April 2008 that they should float their currencies and go upwards. I think that would be a disastrous policy. But what happened, the euro went up to $1.64 in June of 2008. And at that time, the inflation rate was 5.5%. Now, the Fed started to do something, but there was something tightness coming on. There were a lot of inflation hawks saying that the Fed should be much tighter, and they were looking at the money multiplier model and were thinking that there'd be a big upsurge of inflation. So the Fed did some tightening, and the dollar started to soar. And the Europeans were screaming for more dollars to cover their assets. But what happened is that the dollar then, the euro went down from $1.64 to $1.23, about a 30% drop in the euro in the space of about 3 months. 30% drop, enormous. What effect did that have on the economy? Well, the inflation rate went down from 5.5% in June, as I said, of 2008, down to 0 at the end of the year, and then minus 2% in March when Bernanke introduced his first QE1. He started to finally realize that it had been too tight and the inflation rate was not only too low, it was negative, it got down, but it was driven down by the exchange rate. The exchange rate is the mechanism by which this was brought down, just as in the 1980 period. It was the exchange rate that brought the inflation rate down, because the dollar in the 1980 period went from the Deutsche Mark, which is the representative of the European currencies, the dollar went from 1.7 Deutsche Marks in 1980 to 3.4 in February 85.
So Bob, you're basically saying that monetary policy was responsible for the crash, for the financial meltdown. What should the Fed have been watching for at that period? You said inflation was 5.4%. Obviously, that's too high for the long run. Should they have just let that, assume that that inflation was already built into the system and let it go, and then worked with the European Central Bank to get to some coordinated monetary policy? Or what should they have done at that moment to prevent the crash?
Well, they should look at the exchange rate. Now, if the responsibility for international monetary policy is not the Fed's, it was the Treasury's. It's always been the case. It's the Treasury that is responsible for international monetary. The Secretary of the Treasury is the governor of the International Monetary Fund. The chairman of the Fed is the assistant governor or alternate governor. He's the second man on the tier. In every country in the world, with one or two exceptions, including China is one, the government is in charge of the exchange rate policy. And that's the problem, that Bernanke doesn't have an exchange rate policy, and no Fed governor has one, and probably legally couldn't really have one because he doesn't own it. It's the Fed that has, it's the Treasury that has to have it. And the Treasury was sleeping on this and didn't take account of this. When they were seeing this, when the dollar was soaring, people said, oh, safe haven. And they were all happy because, oh, they thought, well, the world was crumbling around, the exchange markets were all crumbling, the banks were collapsing, and General Motors was going bankrupt, and all these things were happening, and they were happy because the dollar was soaring. 30%, the greatest increase in peacetime that's ever been allowed. What they should have done, if they had been allowed to, and if they'd prepared this, would be simply buy euros, because nobody thought the euro should be down at $1.23 at that time. They should have bought euros at $1.35 and 40, and then that would have solved the problem. And that's now the same is true with the Europeans, because the Europeans got into great difficulties when the euro went up to $1.64.
They should have been buying euros.
If they'd been able to stop that, they might have not had such a big sudden rush and collapse in their fiscal situation.
Okay, Bob, what about the current moment in monetary policy? Because there's been a lot of criticism of the Federal Reserve as being too easy with QE2 and so on. What is Bernanke, he's still not paying attention to the exchange rate, I can tell you that. It's not a factor in any of his calculations as far as I can tell. Is the Fed storing up trouble, and what would you do if you were sitting at the Treasury right now?
Well, the economy is the major problem. there's a great weakness in the economy, and you don't want to do something to cut off whatever very poor growth is going. Look what happened when, as I said, Bernanke went into his QE1 policy in March 2009. Come around 9 months, then things start, you got a good recovery going. Seemed to look as if we were going to be a good recovery. But then in November 2010, he had to have another QE1 policy. Why was that? Well, somewhere in between came up this fact that the dollar soared again. The euro went down again by June 2010 to $1.18, even below what it was before. And with the economy recovering, the dollar started to go up, and the European fiscal situation weakened the euro, and this hurt the dollar and choked off the recovery. And so that mistake of letting the euro go down and the dollar rise again by June of 2010 killed off the recovery and made QE2 necessary. What I'm afraid of now is that I don't want to have to see another tightness in the dollar. I don't want to see the euro go way down, the dollar go up again, and cut off the recovery again, and make necessary a QE3. I think the risk right now, the risk to the recovery of cutting off the recovery is greater now than the risk of inflation. I know the thing about the money multiplier, which is fallen in half, and so there's a potential for going out. But the other side of it is there's tremendous deflationary pressure still in the world, in the works. And you get that the lack of lending. It's not, you're not getting much bank lending, you're not getting investment. You need to, it would be disastrous to have a policy of tight money now that would cut this off. Just remember the mistake that was made in the 1930s when the Fed tightened in 1937 and brought on that secondary recession. And that was a very disastrous recession for the United States.
So you're not worried at all, Bob, about oil prices and commodity inflation and food prices?
What?
You're not worried right now about the price of oil being over 100, about food prices and commodity prices pushing through to affect, really hurt middle class and lower income standard of living?
Well, the price of oil came down yesterday, and it came down this morning. And I'm not, it's high, of course, but remember it was 148 in the middle of the crash, and it went up to 148 in the third quarter of 2008, and then it went down within 3 months period to $33. This tremendous instability. So we're not anything like that yet, and I don't think this is an inflation problem. I think you have a lot of things connected with the Middle East that are involved in this current round of oil. Of course, it's a risk, and I'm not saying that but it's not the expectation. The expectation of inflation will show up quickly in shooting up of the gold price. You haven't seen that over this period.
Well, $1,400 an ounce is a pretty...
Gold is still near its all-time high. I know, it's 1426 or something. So it's very close to that. But we're in a world still where the threat of a long continued recession, cutting off this recovery, and I think it is going to be very, very damaging to the budget situation if you allow that to go on. So if you start to cut that off, the priority, the tremendous budget deficit, the tremendous debt level that's hurting the United States, and the weak economy that is not. I wouldn't recommend it at all. If I run the Fed, I would not be voting for tightening at this time.
All right, let's open this up to folks in the audience. Do we have any questions? Yes, Roy. Please wait for the
Dr. Roy Murdoch with the Atlas Economic Research Foundation. At Ronald Reagan's centennial, I was struck by how positive the comments were about him, not just among folks around the country, but even most of the popular press was generally pretty positive. I'm wondering, looking at Reaganomics in particular, among the academy, your colleagues at Columbia and elsewhere, other academics, how is Reaganomics regarded among the academic economic departments? Is it admiration? Is it grudging respect, or still a ridicule and dismissal?
Did you get that, Bob?
No.
The question is, at the centennial, Reaganomics was celebrated. What is the perception of Reaganomics within your profession in the academy? Is it respected or not?
I'm afraid to say that at least half, if not over half, don't like it, and they never liked it. And but the bottom line is that no one is advocating putting back tax rates to what they were in the late 1970s. And I think this is the victory. And the spread of the lower tax rates all around the world is the best indication of moderate success, remaining in it.
Any other questions? Anybody have any at all? Yes, sir. Right over here.
Lately, there's been talk about value-added tax as a solution for the expansion of government, and even, some folks have been identified with supply side, like Bruce Bartlett, have advocated it. I'd like to get Mr. Mundell's take on that. Are we gravitating in that direction?
Bob, the question was, Larry Lindsay, who was on stage earlier, has advocated something like a value-added tax, as have other people here and there who are identified as supply-siders as solving the fiscal problem, a value-added tax. Mm-hmm. What do you think about that as a solution?
I think it's a terrible idea. Because there's nothing wrong with the value-added tax itself, but what in fact would happen if you replaced the income tax with a value-added tax, I'd say okay, but you're not going to replace you're going to add the value-added tax, and you're going to keep the income tax, and you're going to have a disastrous situation.
Just a money machine, then. It just raises my... Okay. Yes, sir, right here in the front table. He was first.
Ed Thompson with the Ayn Rand Institute. There's been not much discussion today about an entitlement reform. And of course, that's the elephant in the room as far as where we're going in the out years. There was an article in the Wall Street Journal just yesterday on the corruption, fraud, and bankruptcy of the, disability insurance portion of Social Security. So between Social Security and Medicare, Medicaid, and this may be more of a political question for you, sir, do you see entitlement reform in the cards? And if not, what happens? How long do we have before disaster strikes?
We haven't talked very much today about entitlement reform, entitlement reform, Social Security, Medicare. The question is, how urgent is that? And if we don't do something about it, what happens?
Well, it's very urgent, but when you've given people things, it's very hard to go back, to turn back, at least in one generation. It's like the big mistake of the entitlements that with the system got on. Initially, the plan was to have tax, and the first generation of elderly wouldn't take pensions out because you'd build up a fund for it, and it would be self-sustaining in some sense. But people wanted it quickly, and their children wanted them to have it quickly, so they wouldn't have to pay for it. So that was the bargain that was made, and then it's got up very high now, and it's going to increase. You can see, well, Canada is an example, and Europe, and then Sweden, and you see what happens in that case. So I think I don't know how you can turn these back. I think if you can make a better medical choice, better medical plan, that would be a good good start. But you need to find a good politician who's also a good psychologist to find the way to solve that problem.
That means basically the only way out of this is to grow our way out so we can pay for the benefits we promised. That's the essence of what you're saying if you can't reform them. Yes, sir, right here. Right there.
Thank you. J.P. Dunlin, Chief Executive Magazine. This question is chiefly for Brian, but Paul or Bob Mundell will be helpful as well. Given the message of the importance of growth, Paul just alluded to it, and given also that there's a great deal of experimentation among the states, which states, Brian, would you point to as being particularly illustrative of policies, good growth policies, that might conceivably be adopted at the national level? And which states are good examples of what not to choose?
I think,
He's got
is this working?
Is that working?
Yeah.
I don't know. Is it working?
For a second. Is that working? Yeah, that's working. Which states? I think it's a question. I think I come from Texas. I mean, Texas is a state without an income tax. Of course, it can't control its own monetary policy. But the thing is, there's a flip side to monetary policy. It's labor markets. And this is something that Professor Mundell spoke about in the other half of the work that won him the Nobel Prize, his work on optimum currency areas. When you have a tremendous amount of labor market flexibility across the border, as you do in Texas, when you have really low taxes, people start businesses and you suck labor into it. And that's what we're seeing there, and that's why our economy is booming. And I should point out that our house values have been stable throughout the entire recession.
Very interesting. Yes, sir, right here. Can we please wait for the
John Chapman of the George W. Bush Institute. I'd like to ask Professor Mundell, Chairman Bernanke, following Chairman Greenspan, have both said there were no errors in monetary policy in the middle of the last decade, that there was in fact a savings glut, which caused expansive or too much investment. I'd like you to comment on that. Does economic theory even allow that there could be too much capital formation? And a corollary to that question is there a threat of a collapse in the U.S. bond market, and what are you advising the Chinese to do in terms of monetary policy and their U.S. dollar asset holdings now?
That one I think I heard. It was about asking you to respond to Chairman Bernanke's explanation of the savings glut before the crash as being one of the causes of the crash. Can you have really too much capital formation, which he suspects is that's what Bernanke was really claiming? And what with the second part? Well, let's answer that first.
Well, I don't think that there was an increased pool of saving for mortgages that came about because of the securitization of these in ways that were very ingenious, and I think that, but that wasn't anything to cause a big recession. Except, of course, you have more capital coming in to the market, you have more houses being built, but people, as long as they're creditworthy, there's no problem from it. But of course, the housing market turned down, and after that, you had that crash. But when every recession, you get a movement in housing prices, and it's not fundamentally different from this. I think by far the most important factor, you see, look, in 2007, August 2007, the subprime mortgage crisis came to a head. That was 2007. And the European Central Bank and then other central banks issued in 2 days, 9th and 10th of August, $300 billion of new money in it. And that helped the liquidity problem for the crisis. Now, all the banks have to work off any bad assets they have, and that was certainly going on. But the crisis came that we all talk about now isn't that mortgage crisis that went on then. It was 13 months later with the Lehman crash, with the crash of the housing institutions. Just think what happens at 30% appreciation of the dollar, what that does to the housing market. The housing market went down further, or aggravated over that period, and it overvalued all these weak assets even more than they did before. At the same time that that 30% appreciation would just have a killing effect on companies like General Motors with international markets and so on. So I think that that Bernanke hasn't realized that phenomenon yet of this appreciation as the major correctable problem of the mortgage market.
I can tell you he does not recognize that. That is for sure. Yes, sir. Right here. And we got two more questions. This one and one more. I'm afraid that's it.
Paul, interest. Given that we have a fiat currency, is it possible to get a stable value by adopting a rules-based policy like the Taylor rule? And given that we have floating exchange rates, does it have to be an international agreement, or can we do that as a country?
Given a world of flexible exchange rates, do we have to have a gold reference point? Was that?
Can we use the Taylor rule?
Oh, can we use the Taylor rule to set monetary policy, or do we need some other reference point, such as commodities? And that's a question.
Well, you didn't say this, but I think I know what you're thinking. You're absolutely right. The Taylor rule isn't the right rule that should be followed. The rule that I think should be followed is that every time there's just take with the United States example, like other countries, every time there's a big depreciation of the dollar and it's combined with an increase in the price of gold and other things, you have to start worrying about that as a phenomenon of inflation to tighten, and like in the 1970s and so on. And when it's too high, when the dollar is going up, you have to address the problem. Is that a problem? What happened to the price of gold in the third quarter that I was talking to you about? Well, at the beginning in June, the price of gold was $980 an ounce. In October 24th or something, it was $720. So you had a 30% fall in the price of gold over that three-month period too. So you have to, supply-siders like Art and Jude Winiski and Jack Kemp and all the others always knew that you have to look at the price of gold and the exchange rate as a symptom of inflation. Now, the argument that the Fed might have if they use the Taylor rule, they probably don't admit they use the Taylor rule, but there's no exchange rate in it. They would say, well, we have the exchange rate implicitly in it because we look at the rate of inflation, and the exchange rate will change the rate of inflation. And of course, that's correct. But there's about a 6-month lag. There's a long lag before a change in the exchange rate affects the consumer price index. And that's what they use for this. So it's what you get is an early warning mechanism. So the Taylor rule needs to you can look at unemployment, all right, but you have to look also at the exchange rate. And look at the inflation rate, but also the exchange rate to back it up.
All right, I think we have one more. Yes, sir.
Thank you. Graham Kirby, the world, Europe, America seems to be drowning in debt. How can that debt be dealt with, either bankruptcy law or inflation, as they seem to be doing now?
The question being the debt that has been built up, how are we going to deal with that? Will it require an inflation, or is there some other way we can get out of it?
The last time the U.S. had a huge debt GDP buildup was in 1945. The debt GDP ratio was 125%, and the U.S. dealt with that by a 50% inflation up to 1950. And the debt GDP ratio came down along with growth and so on to about 55%. So that was seemed to be, nobody worried about that. Nobody talked about that much. Nobody really seemed to notice that. Keynes had talked about it before, but it wasn't. I don't think we can do that anymore. I think you can't do that. The public, Pandora's out of the box. People know too much about that. They would sense that strategy. And the moment you start to have that, and people sense that you're going to have an inflation to build up, everything breaks loose in the whole system. You have a collapse of the system. You can't do that, just as Europe can't do that any longer. They have to do this very hard work of getting down to work and putting things back together again.
So what do you do about the debt? You just work your way out of it through growth?
Well, the first thing is the big problem is the budget, the debt level. And then there's the commitments that aren't allocated. Most countries, it's about twice. Every system should be fully funded. There should be finance for every new program that comes in. And it should be a very generous finance to make allowance for the fact that federal programs always get bigger and bigger and bigger. So you need maybe 50% extra allowance for the future growth of these, or you're going to have these huge unfunded liabilities. They're now probably, I don't know who knows what they are today in the United States. Is it, would it be 50% of GDP to add to the funded liabilities? I think maybe at least 50%
That's
of GDP.
That's
in
optimistic.
Europe, it's but you double countries have a 90% debt level, and they have another 90% of unfunded liabilities to worry about.
Well, on that perhaps optimistic note, I want to thank Bob Mundell for coming and sharing this moment with us. Brian Dimitrovic for his book and for helping us. I want to thank the Manhattan Institute for hosting this, the Reagan Centennial Committee, and the Smith Foundation. And I want to thank, and on behalf of the Wall Street Journal, and I want to thank all of you for coming. I think it was a very fruitful day. Thank you so much.
I think it is clear how fortunate we are to believe in the power of ideas.
Supply the common sense and the fresh thinking of the Manhattan Institute.